You felt it, right? A general sense of unease in the markets. Stocks, bonds, even crypto. Everything feels like it's on shaky ground. It seems random, chaotic. But what if it's not? What if a single hidden force that has been secretly juicing global markets for decades has just been switched off? For years, a strategy estimated to be worth trillions of dollars, known as the yen carry trade, has been the silent money printer for investors worldwide. But now it looks like the party is winding down. Now, that's a bold claim, and the reality is a bit more complicated, but the era we knew is absolutely over. The unwinding of this trade is changing everything, and today we're going to break down exactly what that means. So what exactly is this legendary yen carry trade? At its core, the idea sounds simple, maybe a little too simple. It's a strategy where investors borrow money in a country with super low interest rates and then invest that money in a country with higher interest rates. For the better part of 3 decades, Japan has been the ultimate source for this cheap funding. While the U.S. Federal Reserve and other central banks had rates of 4% or 5%, the Bank of Japan, BOJ, kept its interest rate pinned near zero, and for a period from 2016 to 2024, even pushed it into negative territory. Think of it like this. Imagine you could get a loan from a bank in Tokyo for a 0.5% interest rate. You then take that borrowed yen, convert it to US dollars, and buy a US government bond that pays you 4.5%. In theory, you pocket the 4% difference, the carry, for doing almost nothing. Now scale that up to millions or billions of dollars, and you can see the appeal. It was often described as the closest thing to a free lunch in global finance. But here's the crucial catch that makes this trade anything but free: currency risk. The whole strategy only works if the exchange rate between the Japanese yen and the US dollar stays stable, or even better, if the yen weakens. If you borrow in yen and the yen suddenly gets stronger, you have to pay back your loan with more expensive yen, which can wipe out your profits and even lead to catastrophic losses. For decades, that risk seemed manageable. The Bank of Japan wasn't just holding rates at zero, it was actively trying to keep the yen weak to help its export-heavy economy. This created a seemingly perfect storm for investors. You had cheap borrowing costs and a currency that was expected to lose value, supercharging returns for anyone borrowing yen to buy foreign assets. This wasn't just a niche hedge fund strategy. We're talking about a flood of capital from banks, pension funds, and even retail Japanese investors. While official figures are hard to come by, many analysts estimate the leveraged trade in the hundreds of billions, with the wider world of yen-funded investments in the low trillions. This massive outflow of capital acted like a hidden stimulus for the global economy, helping to fuel stock market rallies and suppress bond yields everywhere. A weak yen became shorthand for risk-on sentiment. When the yen was falling, global markets were often rising. However, this free lunch has a nasty history of causing violent indigestion. When a major crisis hits and fear spikes, investors don't walk, they stampede for safety. They dump their risky assets and pile back into the yen to repay their loans. We saw this happen during the 1998 Russian debt crisis, and again in the 2008 global financial crisis. In both cases, the carry trade slammed into reverse as the yen strengthened violently, forcing widespread liquidations and making a bad situation much worse. These events were a brutal reminder that the carry trade wasn't a low-risk ATM. It was a leveraged bet that could and did blow up spectacularly. For years, the Bank of Japan was the most predictable central bank in the world. While others were hiking rates to fight inflation, the BOJ was firmly committed to its ultra-easy money policy. But now, the ground in Tokyo is shaking. The conditions that made the carry trade a one-way bet are fundamentally changing. After decades of fighting deflation, Japan is finally seeing persistent inflation. Core inflation has remained above the Bank of Japan's 2% target for a significant stretch, and with signs of long-awaited wage growth, the BOJ finally got the green light to start normalizing its policy. Back in 2024, the bank officially ended its negative interest rate policy, and now the market is bracing for more. As of early December 2025, hawkish comments from BOJ Governor Kazuo Ueda have led markets to price in the possibility of another rate hike at the December 18th to 19th meeting, potentially bringing the policy rate toward 0.75%. While that sounds low, it represents a monumental shift for a country used to zero. This has sent shockwaves through Japan's own bond market. The yield on the 10-year Japanese government bond JGB has surged, recently hitting around 1.95%, a level not seen in over a decade. For years, this yield was artificially squashed near zero. Now it's a real functioning market again. And for the first time in a generation, Japanese investors are starting to see a decent return on their own government's debt. So what happens when the very foundation of a multi-trillion-dollar trade starts to crack? You get an unwinding. It's not happening all at once in a single day of panic, but it's happening. We're witnessing the slow, relentless reversal of decades of capital flows. First, the simple math of the carry trade is breaking down. The interest rate difference between the US and Japan, while still wide, is narrowing. As the BOJ hikes, the cost to borrow yen goes up. Meanwhile, with the Federal Reserve widely expected to start cutting rates in 2026, the return on US assets is set to go down. This compression makes the trade far less profitable and a whole lot riskier. This forces hedge funds and other leveraged players to rethink their positions. The risk of a sudden spike in the yen is now much higher, and many are choosing to cut their exposure and close out their trades. This means selling the assets they bought with borrowed yen, US stocks, European bonds, and yes, even crypto, and buying back yen to repay those loans. We've already seen flashes of this, where a sudden yen rally corresponds with sharp sell-offs in global markets. But the even bigger story is the potential for repatriation, or what some are calling the Great Rebalancing. Japan is one of the world's largest creditors, and its massive pension funds and insurance companies hold enormous amounts of foreign bonds. For years, they had no choice but to look overseas for any kind of yield. Now, with their own domestic JGBs finally offering a positive return, that incentive is flipping. While a massive wave of selling hasn't fully materialized yet, we are seeing the beginning of a huge reevaluation. These institutions are slowly starting to bring some of that capital back home to invest in JGBs. This creates a steady underlying selling pressure on US Treasuries and other global bonds. It's a contributing factor for why US bond yields may stay higher than many expect, even if the Fed starts cutting rates. This isn't a tsunami of selling overnight, but a powerful tide pulling capital back toward Japan. The end of the yen carry trade's golden era ushers in a new regime for global markets, one that's likely to be defined by tighter financial conditions and higher volatility. For the average person, this isn't just some abstract financial story. The unwinding contributes to a world of higher borrowing costs. While local factors are always the main driver, this global tightening puts upward pressure on everything from government debt to mortgage rates. A world where Japanese capital is going home is a world with less demand for US debt, which can contribute to higher rates for everyone. So is the trade officially dead? Not entirely. As long as a significant interest rate gap exists, some form of the carry trade will survive. However, the one-way bet of the last 30 years is over. The risks have skyrocketed and the easy, lazy profits are gone. The trade is no longer a silent, stabilizing force, but a source of volatility and uncertainty. Investors should be watching three key things. First, the USD and the JPY exchange rate. Continued sustained strength in the yen will accelerate the unwinding. Second, the spread between US and Japanese bond yields. As this gap narrows, the pressure mounts. And third, the policy announcements from the Bank of Japan. Every meeting now carries the potential for a market-moving surprise. Navigating this new environment is going to be tricky. The ripple effects of Japan's policy shift are just beginning, and they will be a major theme for years to come. If you want to stay ahead of these macro shifts and understand how they impact your portfolio, make sure you subscribe to Substack for our weekly breakdowns. For decades, the global financial system was powered by a hidden engine, a torrent of cheap money flowing out of Japan. That engine is now sputtering. The yen carry trade, as we knew it, is undergoing a fundamental transformation. It's shifting from a source of cheap leverage and market stability to a driver of volatility and risk. The slow, grinding process of this unwind means the consequences, from higher global bond yields to sudden shocks in currency markets, will be with us for a long time. The silent money printer has been switched off, and the world is just beginning to adjust to the silence. History rhymes. Power rebrands. Stay inquisitive.